Welcome to this explainer on the Trade Desk's Q1 2026 earnings. Today, we're putting on our sell-side equity analyst hats. Our goal? To extract the hard data directly from their Q1 10Q and earnings call transcripts, evaluate their operating segments, and build a precise, fully documented stock valuation from the ground up.
We're strictly looking under the hood of this market-leading independent demand-side platform. We're grabbing facts exclusively from their latest filings, management commentary, and supplementary data. We want to cut through the market noise and focus entirely on the actual business reality unfolding out there on the open internet.
Here's our game plan. We'll set up the investment thesis, do an operational deep dive, review financial health and risks, calculate cash flow and WACC, build out our DCF valuation, and then deliver the final verdict.
Section 1. Let's address the immediate market reality.
Following the Q1 earnings report, the stock took an absolute beating, trading near $20 per share in extended hours. Now, they actually posted a top-line revenue beat of $688.9 million, but an EPS miss and softer forward guidance totally spooked the market. So, as rigorous analysts, we have to ask, is this a rare bargain, or are we just trying to catch a falling knife?
Let's look at the multiples. According to Trefis Analysis, at that $20 price point, the Trade Desk is trading at a forward PE multiple of just 9.7 times, assuming $2.06 in estimated 2026 earnings. Just look at that compression. That's down from a 3-year average forward PE of roughly 42 times. It's literally sitting well below the S&P 500 average. For a market-leading tech platform, a single-digit multiple definitely warrants a much closer look.
Moving on to Section 2, our operational deep dive into the business reality.
Pulling straight from interim CFO Daniel Davis's remarks on page 17 of the transcript, let's look at their channel mix. Connected TV, or CTV, is the undeniable heavyweight here, making up a low 50s% of their business. Mobile sits in the high 20s, and display is in the low double digits. But keep an eye on audio. It's only about 6% right now, but it's currently their fastest growing segment year over year, largely driven by massive partnerships with platforms like Spotify.
Geographically, the filings show they are heavily weighted toward the U.S., generating 82% of their revenue domestically. However, that remaining 18% from international markets like EMEA and APAC is gaining serious momentum. That's the direct result of years of deliberate infrastructure investment overseas starting to pay off.
Now, the crucial point regarding their competitive moat is their absolute independence. On page 13 of his prepared remarks, CEO Jeff Green highlighted that their retail data marketplace covers more than 80% of top U.S. retailers. Compare that directly to Amazon, which captures less than 15% of U.S. retail spend. In the high-stakes game of programmatic advertising, being objective and having that kind of comprehensive data access is a massive advantage.
And the operational momentum within their product ecosystem backs this up. Joint business partnerships, or JBPs, skyrocketed 55% year over year. They signed a staggering 45 of them in March 2026 alone. And we're seeing them steal market share. Case in point, a major pharma client actually shifted away from Amazon back to the Trade Desk, increasing their spend by 114%. Plus, tests of their new Audience Unlimited product delivered a 75% more efficient cost per action. Their agentic AI and outcome-driven platforms are legitimately delivering hard ROI for advertisers.
Section 3. Financial health and risks. Let's bridge the narrative to the hard numbers.
They delivered a solid $689 million in revenue, up 12% year over year. However, as noted right in the MD&A section of the release, adjusted EBITDA margins did compress slightly to 30%, down from 34% a year ago. Management made it explicitly clear this was due to deliberate infrastructure investments, specifically completing their transition to own data centers and aggressively investing in AI capabilities.
But here's what actually spooked the market. In the risk factors and forward-looking statements, management flagged some severe near-term macroeconomic headwinds, geopolitical tensions, increased tariffs, and specific weakness in consumer packaged goods, home and garden, and the auto sector are creating cyclical pressure. Because of this, their Q2 revenue guidance was set at least $750 million, which implies a deceleration to roughly 8% year-over-year growth. For a company used to a 28% historical compound annual growth rate, that's a very noticeable step down.
Section 4. Cash flow and WACC calculation. Time to gather the inputs for our valuation model.
First up, liquidity. Glancing at their Q1 balance sheet, they generated a robust $276 million in free cash flow, just in Q1 alone. More importantly, they are sitting on an absolute fortress of a balance sheet with $1.4 billion in cash, cash equivalents, and short-term investments. That gives them tremendous flexibility to navigate a turbulent macro environment. Now, to discount our future cash flows to present value, we need a discount rate. Since the filings don't provide an explicit WACC metric, we have to state our external assumptions here clearly. Using the capital asset pricing model, we're assuming a standard 5 to 6% equity market risk premium with the beta aligned with high-growth ad tech peers. And because of that massive $1.4 billion net cash position we just highlighted, their cost of debt is practically negligible. That means our capital structure is predominantly equity-weighted.
Section 5. The DCF valuation. Let's get to the climax of this explainer and build out our formal discounted cash flow model. We have to bridge from reported earnings to unlevered free cash flow. We start with the GAAP net income of $40 million from Q1. Next, we add back non-cash charges, most notably depreciation, and their significant stock-based compensation, which really heavily skew those GAAP numbers. Then we subtract capital expenditures. Remember those data center investments we discussed earlier? And we adjust for changes in working capital from the balance sheet. This gets us to unlevered free cash flow. This is the holy grail metric. It's the true cash-generating power of the business and forms the baseline for our explicit forecast.
For our explicit 5-year forecast period, we're taking a pretty conservative approach. We factor in that decelerating 8% growth from their Q2 guidance, allowing for a slight re-acceleration up to 15% as macro headwinds fade, largely driven by CTV and retail media growth. As for the terminal value, the value of the company beyond those 5 years, because it's not provided in the filings, we explicitly assume a sensible 2.5% growth rate. Why? Because that perfectly aligns with long-term GDP growth expectations in their primary U.S. markets.
Finally, Section 6, the final verdict. So what does the math actually tell us about this $20 share price?
Based purely on these fundamentals, our cash flow adjustments, and the seeded assumptions, the mid-case intrinsic value target from the ticker advanced model analysis sits at roughly $42 per share. If the company executes on its infrastructure investments and maintains its competitive moat, we're looking at a potential total return of around 81% from current levels.
I think this quote from CEO Jeff Green perfectly captures the current dynamic. He completely embraces the macroeconomic turbulence, the tariffs, the consumer softness. He notes that tough times, or the rain, are exactly when a structurally superior, transparent platform takes market share from legacy competitors. Which leaves us with this final thought to consider. And the core takeaway from our fundamental analysis, in the face of temporary tariffs and cyclical headwinds, has the broader market completely mispriced the trade desk's long-term structural dominance of the open internet? The math certainly suggests a huge opportunity for those willing to look past the rain.